Hello, everyone. Welcome to Align Books. Every business invests in assets, machines, furniture, computers, or vehicles. These assets help generate revenue, but here's the challenge. They don't last forever. Over time, machines wear out, vehicles lose efficiency, and computers become outdated. If businesses don't account for this gradual loss in value, their books show an inflated picture of profits and assets. This creates three big struggles for business owners. Expenses don't match the revenue they help to generate. Balance sheets show assets at values far higher than their actual worth. And at tax time, businesses miss out on legitimate deductions. That's where depreciation comes in, a systematic way to spread the cost of an asset over its useful life, ensuring your financial reports always reflect the real picture. In this video, let's explore what depreciation is, why it's important, and how Align Books makes managing it simple and accurate. Depreciation is the process of spreading the cost of a fixed asset, like machinery, vehicles, or equipment, over its useful life. In simple terms, it reflects how assets lose value over time because of wear and tear, usage, or aging. But why do we use depreciation? To match expenses with revenue over time, to ensure accurate financial reporting, to show the true value of assets in the balance sheet, and to take advantage of tax deductions where applicable. There are two widely used methods of depreciation. The first is the straight-line method, or SLM. Here, the depreciation is equal every year. The formula is simple. Depreciation per year equals the cost of asset minus residual value, divided by useful life. For example, if an asset costs 1 lakh rupees, has a residual value of 10,000 rupees, and a useful life of 5 years, depreciation will be 18,000 rupees per year. The second method is the written-down method, also known as the diminishing balance method. Here, depreciation is charged on the book value every year. This means the depreciation amount reduces year after year. The formula is book value multiplied by the rate of depreciation. For instance, an asset costs 1 lakh rupees and the depreciation rate is 20%. In the first year, we take the book value of 1 lakh rupees and calculate 20% of it. That comes to 20,000 rupees. So the asset's value at the end of year 1 is 1 lakh rupees minus 20,000 rupees, which is 80,000 rupees. Now for the second year, we don't calculate on the original cost, but on the reduced book value of 80,000 rupees. So 20% of 80,000 is 16,000 rupees. After deducting this, the book value at the end of year 2 becomes 64,000 rupees. This way, every year depreciation is calculated on the remaining balance, and the amount keeps reducing year after year. Now, let's see how to record assets in Align Books. There are two possible situations. Case 1. You purchase a new asset. Suppose your company has purchased Apple laptop. To record this correctly, first, create a new item and generate a purchase bill to enter the purchase details, such as item, quantity, rate, GST, etc., and save the invoice. Next, add this item as an asset. Open the Asset module, select Asset Item, and click on Create New Asset Item. First, enter the name of the asset and choose the appropriate group. If needed, you can create a new group using the plus icon. Next, select the type of asset, whether it is trade goods, a fixed asset, rental, or any other category. After that, choose the unit. In the Posting Ledger field, select the ledger where this asset should be recorded, and also specify the ledger for posting its depreciation. Setting these options correctly is very important to ensure accurate accounting. Once everything is finalized, click on Save. Now you need to transfer the purchased inventory into an asset. Open the Asset module and choose the Inventory to Asset option. Select the branch where you want to convert the asset. Next, pick the inventory item for which the purchase bill has already been generated. Then choose the Asset item, where this inventory will be added. Enter the quantity, cost per asset, the opening value of the asset on which the depreciation will apply now onwards, and specify the total number of months on which the depreciation will charge. Suppose total life of your laptop is 18 months. So mention 18 here. Finally, click on the OK button to complete the process. The software will automatically generate an asset item code for each asset, based on the quantity you have entered. After that, fill in the purchase details such as bill number, date, vendor, description, and any remarks if needed. Once all the information is entered, click on the Save button. With this, the process of recording the asset details is complete. Now, let's see the case 2. You already have the asset in your company. In this situation, you don't need to create a purchase bill. Instead, directly go to the Asset module, create an asset item, and save it. Then, record the opening details of the asset. For this, click on the Opening Transactions icon and choose the Opening Stock, Fixed Asset option. Select the required branch and confirm by clicking OK. From the drop-down, pick the asset and enter its details such as asset number, purchase date, vendor, cost, opening depreciation, and other required information. Finally, click on the Save button to complete the entry. Next, to enable depreciation, click on the Configuration icon and go to Company Setup. Open the Finance tab and scroll down to the Depreciation Rate section. Here, select the posting ledger of your asset. You can then decide whether to calculate depreciation using the straight-line method or the written-down method. For both methods, you have the option to apply the rate as per Income Tax Act or Companies Act. For example, let's set the rate for the written-down method as per the Companies Act. Once done, click on the Save button. Based on this setup, AlignBooks will automatically calculate depreciation on your assets. To track depreciation and asset details, go to the Reports module and select All Reports. Click on More Reports and scroll down to the Assets section. Here, you will find 3 detailed reports: Asset Register, Asset Transfer Register, and Asset Depreciation Register. Let's understand the depreciation calculation through the Asset Depreciation Register. First of all, click on the Filter button and select the month of July to view the depreciation for this month. Make sure to check the depreciation on written-down method based on the Company Act. Here, you can view the depreciation on the Apple laptop for this month is $277.78. As the cost of asset is $5 lakh and opening value of the asset is $4,95,000. If you deduct opening value from cost of the asset, you will get $5,000 value. Divide this by remaining months, that is 18. You will get the depreciation value for this month, that is $277.78. Now let's calculate this closing value of the asset. How much your asset value remains. Cost of the asset is $500,000. Multiply this by rate of depreciation, that is 10%. The value you will get is $50,000. Now multiply this $50,000 by 31 days, as you want to view the depreciation for July month, and July month have 31 days. Then divide it by 365. No of days in a year. You will get the value of $4,246.58, which is the closing value of your asset. That's how you can calculate the depreciation. It ensures your books show the real value of assets and accurate profits in AlignBooks. To book a demo, call us or visit our website, alignbooks.com. Thank you for watching. For more videos, subscribe to our YouTube channel and hit the bell icon.